We've got the demand, but what about the supply? Markets and investors struggle with too much of one and not nearly enough of the other. This is Bloomberg Wall Street Week. I'm David Westin. This week, special contributor Larry Summers of Harvard. He warned us about the risk of inflation. What do we do if it is here?
There are precious few examples of where inflation has been brought back down without very substantial economic disruption.
Energy Secretary Jennifer Granholm warns that the shutting down of the Colonial pipeline could be just the beginning of cyber attacks on energy supplies.
This is a serious example of what we're seeing across the board in many places, and it tells you that we need to invest in our systems.
And Dallas Fed President Rob Kaplan tells us it may not be time yet to talk about tapering, but it's getting close.
While you don't want to be preemptive, you also don't want to be so reactive that you're late.
Suddenly, we want more cars and chances to dine out, as we saw in the retail sales numbers on Friday, even as overall purchases stalled. More workers, as we saw in those disappointing jobs numbers last week. But the supply isn't there yet, as we saw this week in consumer prices, with core CPI coming in at a whopping 3% year over year, well above expectations, leaving the Fed to say, once again, it's all transitory.
Under my baseline outlook, these one-time increases in prices are likely to have only transitory effects on underlying inflation.
And the White House warning it's going to be a bumpy ride.
They're not there yet, so there will be more bumps in the road.
And that was before you threw in disruption to a pipeline supplying 45% of the East's gasoline, leaving drivers to hoard and the government to warn that we've let down our guard on cybersecurity.
This issue of cyber attacks on our critical infrastructure, especially energy infrastructure, is not going away.
But for investors, the question remains whether we've done too much with all that fiscal stimulus.
I don't know any economist that was recommending something the size that what was done.
And decision makers to claim we all have more yet to do. This time, the markets didn't take it all in stride the way they have in the past, with the stock market having its worst day since February after those consumer price numbers hit us on Wednesday, only to bounce back on Thursday, while 10-year bond yields climbed up toward 1.7 and 5-year break-evens pointed toward more inflation yet to come. So the markets were roiled this week by one thing, really, the prospect of inflation. And we're blessed to have with us the special Wall Street Week contributor from Harvard, Larry Summers, who was really the first to warn about this possibility way back when President Biden proposed his American Rescue Plan back in late January. So, Larry, welcome. Let me say, Jason Furman, an economist you know well, you respect, was on Bloomberg this week saying that no credible economist ever doubted that this was too much stimulus. I don't remember all those economists agreeing with you at the time.
I don't know. I didn't feel like I was echoing the conventional wisdom at the time. And David, nobody knows yet, and it's too early to know, and the record of forecasters isn't great. But I have to say that whether you look at average hourly earnings, whether you look at producer prices, whether you look at consumer prices, whether you look at direct measures of labor shortage, whether you look at market expectations of inflation, whether you look at survey expectations of inflation, I was on the worried side about inflation, and it's all moved much faster, much sooner than I had predicted, and I think that has to make us nervous going forward.
Yeah, no question about it. At the same time, we have a number of people who continue to say it's not that big a problem. They have various reasons for that. One thing they say is it's just specific sort of kinks in the supply chain, that it isn't a larger phenomenon. What do you say to them?
So look, by definition, there are always going to be a few components of the CPI that grew rapidly in any given month. That's what the Carter economists said all through the creation of the great inflation. I think there's some things that are striking. If you look at core CPI this month, it grew faster than headline CPI. That's exactly the opposite of what that idea would tend to predict. If you look at the pace of inflation, it seems to be accelerating. What I'm struck by is how selective people are. I mean, the thing that leaps out at me when I do microeconomic analysis of the price indices is that house prices, by some measures, are up 18% over the last year, but the owner-occupied housing component of the CPI is up like 2%. And so that tells me that we're probably missing something large with respect to housing. And I think if people are seeing their house prices go up at 18%, before too long, they're going to be estimating that the amount they could rent their houses for is going to be going up substantially. So the largest distortion I see in the numbers is with respect to housing. You know, so many people commented on used car prices, and used car prices, surely that's not a trend that's going to continue, but it's only a couple percent, if that, of the index. If you look at the monthly CPI, medical care was zero in the most recent reading. I don't believe for a moment that medical care prices are going to stay at zero, and that's a much larger component of the CPI than used car prices. So it may be that it's going to change. The other thing to say is, let's be clear, the core CPI grew at 0.9%. That's an annual inflation rate above 11%. So there's plenty of room for there to be a lot of transitory factor in it, and for us still to have what would be an extremely serious problem of inflation rising to the 4% range. So I don't think you can dismiss these figures. I also think that if you look at the hourly earnings figures, if you look at the producer price things, all the inputs which have to do with future price increases, those seem to be accelerating as well.
So, Larry, what do you say to the Fed, frankly, who keeps saying it's transitory? And specifically, the argument, as I understand it, is, look, and what we're seeing right now is the necessary reaction of economy coming back online. And once it gets back online, things will settle back down again. So this is just like a relatively short one-off.
Look, anything's possible, and they could be right. But I always believe in government that the right strategy, indeed in life, the right strategy is to hope for the best and plan for the worst. And the Fed seems to be planning for a very benign scenario that we certainly can't count on. And I don't think anybody at the Fed, Vice Chairman Clarida acknowledged this in the last day or two, thought that inflation would be anything like the number we saw in April. I certainly didn't see the slightest hint of a suggestion in anything that came from the Fed that we were going to be seeing wage growth figures pointing to wage growth well above 5%, even for a single month. And look, David, you have to make a judgment. Do we think from here that supply factors are going to be bigger than demand factors, or vice versa? On the demand side, we have $2 trillion of savings overhang. We have $3 trillion of stimulus that's worked its way only partway through the system. We have the continuing consequence of 18% housing price increases and all the money that's going to free up for consumers. And we have the fact that when nominal interest rates stay the same and inflation accelerates, real interest rates decline, and that means people borrow and spend more. That's what we have on the demand side, and all of that is pointing towards more inflation. On the supply side, we have maybe people will go back to work more when unemployment insurance ends. I actually think that's a significant factor, but the administration denies that unemployment insurance is relevant.
Finally, Larry, let's assume, and I do assume, you're right and the Fed is mistaken. What's so bad about going to 3 or even 3.5% inflation? And what does that really do to the economy?
You know, it had a lot to do with, from the point of view of progressives, inflation had a lot to do with electing Richard Nixon in 1968 and electing Ronald Reagan in 1980. From the point of view of attitudes and trust in government, people seeing that the government can't maintain relatively stable prices and stop inflation from cutting heavily into their paychecks has got to have an effect on trust and confidence in government. From the point of view of narrow economics, when you have more rapid inflation, the price mechanism is working less well to drive efficiency. So, you know, you can argue 2.5% inflation, 3.5% inflation. What's the difference? But I think the better part of wisdom is that there are slippery slopes. And once you start a process of accelerating inflation, there are precious few examples of where inflation has been brought back down without very substantial economic disruption and without enormous disruption to financial markets.
And there you have Summers Inflation Watch, the first episode actually with Larry Summers, our special contributor at Wall Street Week, and of course from Harvard. Coming up, if inflation is poking its head up, what's the Fed to do? Dallas Fed President Rob Kaplan says we may not yet be talking about tapering, but that time is coming.
I think I'm going to try to stick to this substantial further progress benchmark, but I think discussion's healthy.
This is Wall Street Week on Bloomberg.
The Fed has done a wonderful job, and the sharp reductions in short-term interest rates have done a terrific job of stimulating housing and autos. They may be done, but we think they will wait a while before they raise short-term interest rates again. I think they want to make sure that the labor markets have stabilized.
That was Abby Joseph Cohen on Wall Street Week back in 2002. And in some ways, things haven't changed all that much. Then, as now, the Fed is keeping interest rates low to stimulate the housing market. Then, as now, it's trying to strengthen the jobs market. But when do you know that it's time to ease off of that gas pedal? That's the question a lot of people are asking. And Dallas Fed President Rob Kaplan says that while it may be too early, the time is coming as we see demand kick in.
So I'm very conscious about the power of monetary policy and the limits of it. And monetary policy, a la the aftermath of the Great Recession, can be very powerful to stoke demand. If you've got strong demand, there are limitations to monetary policy in increasing supply. So I think it's good to be cognizant of that. And my job is to do our work, talk to contacts, and call these developments out. But probably other parts of economic policy away from the Fed will have a greater bearing on these supply issues.
And therefore, when I come back to the jobs numbers, does that affect your view at all about discussion of tapering or even interest rates? You have been more willing than some to say at least we should start thinking about it or talking about it or thinking about talking about it. Did those numbers move you at all on that? Do you still think it's time to start talking about tapering?
And here's what I've said, just to repeat it with precision because it's gotten some attention. We have a substantial further progress benchmark. I voted for that in December. I've supported it consistently. We need to get to substantial further progress before we can start to taper. And we'll have a debate, of course, around the table about what constitutes that fine. What I have said that you're referring to is as we approach substantial further progress, I think it would be healthy to start a discussion in what I've said sooner rather than later. I'm not putting a calendar date on it, sooner rather than later, because I'm seeing excesses and imbalances and side effects of some of these purchases. I think that would be healthy to be able to discuss. And I'll give you one example, the housing market. How single-family homes are at historically elevated levels. That by itself would not as much faze me, although I'd be watching it. But what I'm hearing increasingly is reports of private investors buying homes sight unseen, squeezing out in some cases single-family buyers. And I think that trend has been increasing based on our work over the last couple of months. And, you know, that's an example of a side effect of our purchases. I think it would be healthy sooner rather than later, at least, to have some discussion about, you know, the efficacy of some of these purchases versus the side effects or even unintended consequences. And that's really the main thing I've been saying. And I guess I'll stop there.
Well, you know, you're a student of, have been, of the market so well. Give us a sense of what the markets are telling us right now, because a lot of people are saying if we look at things like Treasury break-evens, for example, real yields, various indicators like that, they're indicating that actually the Fed is likely to move up, either cut back on the buying of bonds and or raise the rates sooner than what the markets really have been talking about.
Yeah, and so I'll stay away from market expectations because they can change on a dime, and stick with focus on the economy. But I think I'm going to try to stick to this substantial further progress benchmark. But I think discussion's healthy. Again, sooner rather than later, because of these maybe side effects or even in some cases unintended consequences. And I think it's healthy. I hope at some point here in the not too distant future, we can begin discussing this.
As you know so well, the Fed has a new framework, I think you call it, for how you address the question of inflation. Yeah. Take that new framework and put it against what we're seeing in, for example, commodities prices right now, because we're seeing some record commodities prices. Does the new framework work with that record commodities level?
I think it does, and I support the new framework. And what it says is we're going to be less preemptive than we've been in the past in terms of anticipated inflation, and you know we're going to be more willing to let the job market run hotter to have more inclusive employment. Having said that, I've also said while you don't want to be preemptive, you also don't want to be so reactive that you're late. In that we have the tools to deal with these inflationary issues, but when you use them late, they can have a jarring effect. So I think that the challenge for us is to find the balance. I think it's the debate is about the implementation of the framework, where I'm sure there will be debate, and I think that's healthy, as opposed to the framework itself.
It's the implementation of the framework. There's also talk about the signals that are being given. There's a lot of talk about punch bowls these days and whether we're already drunk. And if we've taken away the punch bowl too soon, are we going to take it away too late as a practical matter? What do you say to those who say, wait a second, it is time to start withdrawing the punch bowl? We also had the financial stability report from the Fed last week that sort of warned a little bit about risk appetite. Yeah,
I would say I'm very cognizant of either excess risk-taking in the financial markets, the situation with housing I just talked about, and other imbalances. And this very heavily informs my thinking. And at the Dallas Fed and our team, we not only look at data, but we do extensive outreach. And we've dramatically increased it as the pandemic started, because sometimes the data can be late, it can be stale, and that outreach really informs us on how to interpret this data. And so I think people should have confidence that we're around the Federal Reserve System very vigilant and watching this very carefully. And while we may have debate and disagreement, I think our job is to be very much on top of economic developments, even if they're different than what we've seen before, and certainly I think very different than the aftermath of the Great Recession.
And finally, you want to stay away from politics, as you should. That's your job, to stay away from politics, and you never want to take a position on legislation. But how do you project out the future economic path of the United States when you have something like $4 trillion in additional spending that's pending up on Capitol Hill? Do you just wait until it actually happens, or do you anticipate at all the possibility?
Yeah, well, we're privately doing analysis. I usually wait to discuss publicly until some of the things have actually passed. But I would say the following, and I did comment on the concept of infrastructure. We need to grow faster in the United States. Over this horizon, we've still got an issue with an aging workforce, slowing workforce growth, and productivity growth hasn't offset that. And so investments that improve productivity, I think, can help improve sustainable growth and ultimately will help us to deleverage or moderate our debt to GDP growth. But I would say I'm also mindful, and I've said this many times publicly, the path of U.S. government debt to GDP is unlikely to be sustainable. We're going to have to do a number of things, which I'll stay away from those because they're sensitive, to moderate this debt growth. But improving growth, workforce growth, and productivity is going to be a key part of it. You can moderate your debt growth and you can look at entitlements, but you got to find ways to grow faster.
Thanks to Dallas Fed President Rob Kaplan. Coming up, we take a look at what the week ahead holds for global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It's time now to get a sense of what's coming up next week on Global Wall Street.
David, we have China's monthly activity data dump next week and a busy earnings lineup from Chinese tech companies with Baidu, JD.com, NetEase, and Trip.com reporting along with Tencent as the industry faces increased regulatory scrutiny. And from India, Tata Motors results will be looked to for a sense of how the lockdowns are affecting customers and supply chains. And oil retailer Hindustan Petroleum reports as energy demand slows in India amid the COVID outbreak. The country's oil product consumption fell to a September low in April. And after South Korea unveiled a $450 billion plan to build the world's biggest chip-making base, the country's President Moon Jae-in will be meeting with President Biden at the White House next week. The semiconductor shortage and North Korea will likely be high on the agenda. Danny?
Thanks, Sophie. The focus here over the next week really is the reopening story. In the UK, you have indoor hospitality reopening on Monday, and some German states might also ease restrictions. Of course, there's going to be this question whether the timeline has to change, with Prime Minister Boris Johnson voicing concerns over the variant first detected in India and its spread in the country. Romain?
Thank you, Danny. Earnings during the week will largely center around retail companies, including Walmart, Macy's, Home Depot, TJX, and L Brands. Technology also will be in focus. The White House hosting its second summit on the global semiconductor shortage, and Google's annual flagship conference for developers. It returns after being canceled last year. Elsewhere, hedge funds face their quarterly 13F deadlines for disclosing what they bought and sold in the last period. And the activity in IPOs, which cooled in the past week because of market volatility, that's set to pick back up. Oatly Group, a maker of oat milk, and website designer Squarespace, they're said to be on track for public listings by midweek. David?
Thanks to Sophie, Danny, and Romain. Coming up, if we needed it, we got a wake-up call this week about just how vulnerable we are to cyber attacks. And Energy Secretary Jennifer Granholm says it's just a warning of what could come if we don't take action.
It tells you how utterly vulnerable we are. We're seeing all of these examples of ransomware attacks.
This is Wall Street Week on Bloomberg. A ransomware attack was all it took to knock out the largest pipeline in the United States, disrupting the supply of gasoline and jet fuel to the eastern United States and triggering panic buying that left gas stations dry and motorists scrambling to fill up.
Hoarding does not make things better, and under no circumstances should gasoline ever be put into anything but a vehicle directly or an approved container.
The Colonial pipeline connects Gulf Coast refineries to population centers from Atlanta to New York and carries about 45% of the East Coast's fuel supplies. Without access to much of the East, U.S. refiners snapped up charters either to store gasoline and diesel fuel or to ship the products overseas.
they'll start backing up some of the product. But benefit is, as you know, we were able to get exports of U.S. crude and got that in pretty good volume. So if it can't go through the U.S. refineries, we can put it on the ships and get it shipped around.
Panic buying in the Southeast sent gas above $3 a gallon for the first time in more than 6 years. And more than 3/4 of all filling stations in some cities in South Carolina, North Carolina, and Florida ran out of gasoline.
If you look at what it takes to get a tanker to come to the New York harbor, or for that matter, to pay the premium on a Jones Act tanker out of the Gulf Coast, you'd need a higher price than this.
Shortages also hit the aviation industry, forcing American Airlines to add additional stops to long-haul flights originating from Charlotte, North Carolina.
This is a very big concern because when you look at the airport that Colonial services, it includes Atlanta, Hartsfield, Charlotte, Raleigh-Durham, and Nashville, which are fairly good-sized hubs for major U.S. airlines.
By the middle of the week, Colonial started bringing the pipeline back online and had paid nearly $5 million in ransom to the hackers. But it will still take as long as 2 weeks for gasoline stored in Houston to reach East Coast filling stations, and even longer for diesel and jet fuel because they are heavier and move more slowly.
The ongoing investments are going to be substantial. So I would say this industry continues to maintain a level of vigilance because we understand how important we are and are working hard every day to protect our systems.
This is the latest cyber attack in a string of breaches raising concerns over fragile infrastructure. Over the past few months, a growing number of energy assets have been targeted by hackers.
These ransomware attacks have become greater, more frequent, more sophisticated, and frankly more impactful in terms of the kind of disruption they cause, in this case, of a critical infrastructure.
The woman responsible for U.S. energy policy and security, Energy Secretary Jennifer Granholm, says that the worst of it is that there is likely more to come.
This issue of cyber attacks on our critical infrastructure, especially energy infrastructure, is not going away. This is a serious example of what we're seeing across the board in many places, and it tells you that we need to invest in our systems, our transmission grid for electricity. We need to invest in cyber defense in these energy systems. The private sector has to step up to the plate. Many are, but there's quite a few who have been slow to do so. And I think that these will serve as examples of why it's important to accelerate.
But pick up on your point, Madam Secretary, about where else we might have vulnerabilities. Even before we know exactly what happened, I know you as a leader, your first question is going to be, okay, who else do we have to look at to make sure we don't get hit somewhere else? When you really responded to this, what industries did you look to? What companies did you look to?
Well, clearly the broad array of energy infrastructure. So we had this example of solar winds, which was an attack on the transmission grid. Fortunately, that didn't bring down the system, but it tells you how utterly vulnerable we are. We're seeing all of these examples of ransomware attacks coming, whether it's telecommunications or this critical infrastructure. To me, obviously in my lane, I'm very worried about the energy infrastructure. We don't want to see people lose access to the means to travel, which is what the Colonial pipeline is, or the means to be able to heat their homes or have energy for communicating for businesses or whatever. So this is why, the president has put out this agenda of the American Jobs Plan. And one of the components of that is to invest in our transmission grid, to harden our transmission grid, to make it more resilient to these adverse adverse weather impacts, climate impacts, but also to make sure that it's resilient from cyber attacks. So it's another reason why we've got to invest in these critical components of our infrastructure in order to be secure.
So it's not lost on any of us that this does happen at the time the American Jobs Plan is right up there in Capitol Hill being proposed. Yeah. Help us understand what in the American Jobs Plan specifically might protect us against something like what is going on with Colonial right now.
Yeah, one of the things that is a critical piece of this is a suggested investment in the transmission grid, for example. And that transmission grid, you saw how vulnerable it was in Texas from that wild weather event that happened, the storm in Texas. So that's one component. And we saw how vulnerable it was with respect to solar winds and the cyber attack. This component, this investment, which is part of the American Jobs Plan, will allow us to ensure that we can harden the grid from these kind of adverse events. And that's what's really important. It's one of the reasons, I mean, the president is meeting this week with members of Congress about the American Jobs Plan. He's meeting with Republicans. He's meeting with Democrats. He's entertaining counter proposals. He's really serious about getting bipartisan support. And on the transmission grid, David, I think this is one area where, even though it's not roads and bridges, it is infrastructure. And it's one of the areas that I think we'll see some bipartisan support on.
That was Secretary of Energy Jennifer Granholm. Coming up, inflation was up this week and stocks and bonds were down, at least for part of the week. What does that mean for investors? We asked Catherine Keating of BNY Mellon.
We actually agree with Chairman Powell that we should expect inflation and we should expect it to be transitory.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It was a tricky week for investors as the market has been on a tear, even as some warned of gathering storm clouds. And this week it felt like we just might be feeling some raindrops as well, with those CPI numbers coming on the heels of disappointing jobs numbers last week. So investors have to be asking themselves whether they should be reaching for the umbrella or even running to shelter. We asked Catherine Keating, CEO of BNY Mellon Wealth Management, whether investors are changing their strategy to hedge for inflation.
Investors always have to be concerned about inflation because inflation is one of the things that can lead to the end of a business cycle, tightening rates, recession, bear markets. We don't see that yet. We actually agree with Chairman Powell that we should expect inflation and we should expect it to be transitory. There are a lot of inflationary forces at work in the market. We're reopening. Right? We wouldn't have been here together last May, and yet here we are. We're reopening. And so we need to expect inflation, and we need to expect some surprises because the economy closed down in a very synchronized manner, but it's reopening in stages. And so we need to expect some of these surprises. And I always think that Janet Yellen has a great way of making economics human, and she reminds us it's not just statistics, it's people's activity. And if I think of my own activity in April, I was representing the reopening of the economy and some of those sectors that really drove the CPI increase. I'm grateful to be fully vaccinated. I was traveling on my first business trip, renting a car, flying on a plane, going to restaurants. Those were some of the sectors.
As we address this question of transitory against not transitory, which Jay Powell has talked about repeatedly, how informed should we be about how much money is sitting on the sidelines, particularly in households? There's a lot of money sitting out there that doesn't really have a way quite yet to express itself.
Well, that's right. If you look at households are in very good shape, right? $3 trillion in household bank accounts, savings accounts. You look at stimulus this year that's going to households, which will actually be twice as much as what went last year. $600 billion last year, $1.2 trillion this year. So households are in very good shape, which again is a good sign for the economy because if we think about the 2008 crisis, that's a crisis that really hit households in a different way because of the housing component of it. Households today are actually in very good shape.
To what extent do people run away from bonds in this environment? Because it seems like whatever happens, it doesn't seem like bonds will gain in value very much going out.
Well, that's right. We have seen interest rates, decline for most of our investing lives, and now we're seeing them begin to rise. And so there's always a role for bonds in the portfolio. It's a smaller role going forward. It's a smaller role because, as you note, returns are going to be much lower. But there's always a role, and we're broadening portfolios to get exposure to other things to make up for what you used to get from your bond portfolio.
We're seeing some of the tech stocks get hit particularly hard. Now, they drove a lot of the market for a long time, and they're still well up overall. But at the same time, what is the problem with tech when it comes to inflation? Is it just because they're so richly valued that when people get nervous, they run away from it?
Look, I think there are two things. I think the tech stocks really, led the recovery because of the way we were spending our time last year, right? They really enabled us to keep the economy open to a certain extent. So you saw tech stocks, get very high multiples because of that, and also because investors were willing to pay for growth in a sector that was growing when you had so many sectors not growing. Now what you see is with interest rates rising, it actually reduces the present value of the cash flows and earnings of tech stocks. And so that's what you're seeing, a rotation, but it's a rotation into sectors that we should all be embracing. Mid-cap, small-cap, value, non-U.S. stocks. We think all of these will play good roles in the portfolio.
So follow up on that, who might benefit actually from inflation? For example, financials?
So financials will benefit from inflation, and in particular, the difference between short-term and long-term, right? So that's a sector that benefits. Energy often benefits from inflation. So many sectors benefit from higher rates.
How concerned are your investors right now when you talk to them? How worried are they? Because there's a lot of uncertainty in the marketplace right now. As you say, we've never seen this happen in our economy ever. Shut it down and bring it back. How anxious are people out there?
So if we talk to our clients, they really focus on three things. They focus on the economy because they're business people. They focus on the markets because they're investors, and they focus on taxes because they're taxpayers. And so our clients are sort of living the reopening of the economy as business people. They see the supply-demand imbalances as they're trying to hire and trying to get workers. They've benefited, obviously, from the markets as markets have, tipped to all-time highs in recent weeks, and even now, still up nicely year to date. And so what we're talking to them a lot about right now is taxes. They feel that that's much more uncertain. They know the proposals that have been introduced by the Biden administration, but they're asking us, will they pass? There are very narrow majorities. If they pass, when will they be effective? How will it affect the market?
So one of the questions about tech, actually, that I have is about taxes. Because if you've made a lot of money, at least on paper, by the appreciation of the tech stocks, does it indicate maybe you should sell those right now and take the lower capital gains if you think it's around the corner?
So what we tell our clients, we tell them two things. Number one, as an investor, time is your biggest advantage because markets tend to grow over time. So we say plan, don't panic. Do things that you would otherwise do for your portfolio. Tech stocks rose to be, the 5 largest tech stocks rose to be something like 25% of the S&P 500. If you've got large concentrations, outsized positions, you might want to trim those. You might want to trim those for investment reasons, but also potentially for tax reasons. You might want to consider accelerating some gains to this year if it otherwise makes sense for your portfolio, because rates will probably be higher going forward.
That was Catherine Keating of BNY Mellon Wealth Management. Coming up, cryptocurrencies take a hit from an unexpected source. Advocate Elon Musk. Our crypto experts, Gillian Tett of the Financial Times and Peter Kraus of Aperture Investors, take us through the climate challenges of Bitcoin.
Cryptocurrency is filthy.
I find it, kind of almost humorous that people are investing in Bitcoin thinking that they're doing something that's exciting.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Elon Musk has done a lot to boost cryptocurrencies like Bitcoin and Dogecoin. But suddenly, he's on the other side of the trade, joking about Dogecoin being a hustle on Saturday Night Live, and then reversing his decision to accept Bitcoin in payment for Teslas. We talked with Gillian Tett, chair of the editorial board and editor-at-large U.S. for the Financial Times, and Peter Kraus, CEO of Aperture Investors, about whether the setbacks are just a blip or reflect something deeper.
In a nutshell, well, duh, because we have warned at the Financial Times now for many months that cryptocurrency is filthy. And there's really just two key stats you need to know to understand why. Firstly, about 70% of cryptocurrency has been mined using the computer algorithms in China, overwhelmingly using Chinese coal, mostly in the west of the country. And secondly, the sector has grown so rapidly that it now has a carbon footprint people calculate around the size of, say, Sweden. And that is worrying. I mean, there have been any number of activists, scientists, investors pointing this out and pointing out the tremendous irony that Tesla has been branded as ESG friendly, good for environmental, social, and governance, even while it's got this filthy footprint in Bitcoin.
So Peter, there's more than a little irony here, right? Because at least we tend to think of people who tend to invest in crypto as being very environmentally conscious, and it turns out they may be polluting the environment, warming up, emitting a lot of greenhouse gases.
Yeah, look, I mean, we spend an enormous amount of time every week trying to think about ESG conscious investing. We design investment processes. We have information and data. We look to inquire as to management's views on ESG and how they deal with those different conditions. And investors are demanding, in particular in Europe, but all over the world, investment portfolios that are ESG friendly and, in fact, even ESG compliant with some of the new regulations in Europe. So it is, in fact, a paradox for investors to be investing in Bitcoin, which is exactly the opposite of that. Not even close. And more interesting, to Gillian's point, if it continues to grow, the exponential effect on the poor use of energy, coal, dirty energy, is palpable. And so I find it, kind of almost humorous that people are investing in Bitcoin thinking that they're doing something that's exciting, and at the same time, they're acting in exactly the opposite way that they want the rest of the world to behave.
So Gillian, that says one thing to people who want to buy or hold cryptocurrencies. What does it say for the big banks? Because the big banks are getting some pressure, actually, to manage some funds that actually would include some crypto in it. We have JP Morgan, for example, this week coming out and said, we're really going to get to zero emissions. Everyone wants to get to zero emissions. If they really want to do that, does that mean they can't hold crypto?
Regulators clearly need to start getting involved. I mean, the reason why someone like Elon Musk can have almost this Wizard of Oz-like effect on the crypto market is because it's opaque and unregulated and probably highly concentrated in its holdings. And there are efforts underway now amongst the regulators to exert more oversight, not just over the questions of market manipulation, but also money laundering. And frankly, every single big bank who is dealing with crypto or thinking about it, and fund managers, whether it's Fidelity or Goldman Sachs, needs to throw their weight around it, behind this process big time. And ironically, green issues might turn out to be the issue that causes everyone to rally together, even the libertarians.
I just want to jump in on something to just inject another idea into the conversation. There are two issues around cryptocurrencies. One is the mining issue, which creates this sort of scarcity value and the desire to actually earn something for producing a new Bitcoin. And that, that's the speculative aspect of Bitcoin and the speculative aspect of cryptocurrency. But the more interesting aspect of cryptocurrency is not the fact that it is a speculative value, but that it's a mechanism by which you can actually trade, settle, and effectively record transactions immediately or instantaneously. That's the much more valuable part of crypto. And you don't need mining exercises and energy utilization in order to go after that. So I think you have to start thinking about unbundling the sort of speculative aspect of crypto, which frankly has no value to it. And now we know it's dirty as it relates to the environment. And the actual value of crypto, which is a currency that settles immediately, instantaneously records a transaction, and lowers the cost of transactions in the world, and is the most valuable part. And so I think this might be, to Gillian's point again, the sort of start of unpeeling the onion between the speculative aspects, which frankly are not that valuable, and what the true value of crypto could be over time.
So Gillian, Peter says you can separate out the immediate settlement on the one hand from the speculative on the other. What about another aspect, which is the complete anonymity, which I think we saw this week in the Colonial pipeline hack, actually. As we look at all these ransomware attacks, there have been almost 400 in 2020 alone on infrastructure. Could we have those ransomware attacks without crypto? If you had to actually write a check in your banking account, I'm not sure the ransomware would work.
That's a great point, David. And I think the issue is not so much anonymity, but pseudonymity. That basically we don't know who lies behind these accounts. You can track these accounts, and oddly enough, some law enforcement officials actually think there's a benefit to having this because they can actually see, once you get inside the system, where accounts are coming from. But pseudonymity is absolutely part of the issue. And again, going back to my point that actually green might provide a spark to actually get community support for more accountability and transparency, If you started to create a register of green versus dirty cryptocurrencies, that's the kind of thing that could actually put this on a more mature footing. One other quick point, it's worth mentioning, by the way, that this issue about green and tech is cutting right across the tech sector now. I mean, 2 Google AI ethicists were kicked out of their jobs for co-authoring a paper which said, amongst other things, that the machine learning processes that are used in things like search engines are also pretty filthy. And so you're going to see, or rather, they're consuming an awful lot of electricity and energy. So you're going to see more and more questions being asked of tech companies in general beyond crypto in relation to this going forward, I suspect.
So this is a fascinating point, Peter, I had not picked up on, because in general, I think a lot of the ESG funds, so-called, really heavy up on tech, on the assumption that tech is basically clean. What Gillian's saying is that not all tech is created equal, and we're going to have to get a little more sophisticated, Peter.
Yeah, no, and I think we obviously operate in the investment world, and in Europe in particular, ESG is extremely important. And most buyers of investment products ask the investment teams to be able to actually do detailed diligence on the companies in which they're investing to determine if, in fact, they are operating in clean mechanisms. And most ESG funds that you do see a lot of tech in them. And I do think the point that Gillian is making is a critical one, and one that's going to ultimately differentiate some clean tech versus some dirty tech. And that will have an impact on prices, for sure.
That was Peter Kraus of Aperture Investors and Gillian Tett of the Financial Times. Finally, one more thought. The price is wrong. In one sense, this week was all about prices. The price of gas at the pump, producer prices, and of course, those spiking consumer prices.
The Fed and others have rested a lot on inflation expectations being anchored. This is the type of thing that's going to start to move those inflation expectations.
But there's more than just the economics and Fed reaction when it comes to prices. There's also, of course, the politics. Pocketbook issues always loom large in any election. And even if we may not blame the candidate for what we're paying at the pump or in the checkout line, we at least want the sense that they know what real people in the real world are paying for things. Which brings us to the political price gaffe. Perhaps originating with President George Herbert Walker Bush back in 1992, getting caught out in a presidential debate having no idea what a gallon of milk cost. And then Rudy Giuliani running for president in 2008, just hazarding a guess at the price of milk and getting it hopelessly wrong. History may have repeated itself, sort of, this week in the New York mayoral race, when leading candidates were asked how much an average house costs in Brooklyn. Former Wall Street banker Ray McGuire guessed it was between $80,000 and $90,000. Well, we could forgive him because, after all, at Citi he didn't handle mortgages. Sean Donovan is a different story. He ran housing for Mayor Mike Bloomberg and then HUD for President Obama, and he guessed that a house in Brooklyn would go for about $100,000. Although afterwards he did say that he just got confused because he had too many numbers rolling around in his head. The right answer? Well, that was $900,000. And leave it to Andrew Yang to nail it, though former New York sanitation head Catherine Garcia was awfully close at $800,000. But if it's any consolation, that $80,000 could buy something in Brooklyn. According to Zillow, it may not be a house or even an apartment. There's a parking place in Brooklyn going for $80,000. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.